Okay, good morning, everyone. I hope you can hear me. I see it's 11:01 and people joining at the moment. I think we can start, Itamar. So welcome everyone and good morning to you. We are hosting our third webinar for the iGravity investment solution. Today we are covering investing in agriculture emerging market and how to ensure impact and return. A very interesting topic today. Maybe for those who don't know us, a brief introduction to iGravity. We are a small firm advising since 2017, 100% dedicated to impact investing. And we have three pillars of activity, three core pillars. One is research and partnership, where we advise on innovative finance, use of outcome-driven financial tools, and typically for foundations, DFIs, and government agencies. And we work very closely here in Switzerland with SECO and SDC. We have an impact venture activities where we are investing in venture capital, impact enterprises, and advise on mandates to do so today very much in Africa. And our third pillar is clearly the investment solution, what we are talking about today, where we build diversified impact investment products and mandates. And we have launched our first product more than a year ago now, which is a dedicated impact investing for institutional investors. Today, I'm very happy to have a panel to discuss this interesting topic. So I'm joined with Nabil Marc Abdul-Massih, which is Chief Executive Officer, member of the management of INOKS Capital. Nabil has 20 years of experience in managing commodity investment. He was a physical originator, a trader, collateral manager, risk manager, and portfolio manager. He co-founded in 1996 one of the largest independent originator of West African coffee and cocoa, joined a broker of soft commodities in Africa and South America, was also part of the audit control expertise, that's the ACE company in Geneva, supervising in excess of 800 million of credit facility around 10 commodities. Nabil joined INOKS in 2006, and since then he leads the company and heads the team and investment product to this day. And they've also launched the Ancille Fund since 2006 already. So welcome, Nabil. And around Nabil, we have Itamar Ahrenbeck, which is an investment associate in our impact venture team. Itamar is currently working on different investment windows and managing in sub-Saharan Africa, as I mentioned before. He's providing financing to SME and a specific focus on improving the livelihood in rural areas. Previously, Itamar co-founded the financial advisory boutique, specifically for startup and SMEs. And briefly myself, I'm a partner and head of risk at iGravity. I'm also chairing the investment committee, and I've been in the financial industry for more than 25 years, and recently at Blue Orchard also for 6 years. So today's topic, maybe a few housekeeping rules for you. Clearly, you're on mute, your video is not enabled. If you have any comments, please use the dedicate function in the Zoom panel, and we'll address the question at the end of the webinar or potentially during, if these are interesting in the topic we discuss. So we have 30 minutes today. It's a broad subject as usual. So we'll try to give you an overview of the financing of the different actors in the value chain. And for this, I welcome Itamar to give us a little bit of an introduction to the sector and basically set the scene of what we really do in agriculture financing.
Thank you, Fred. So first, I will be kind of speaking a bit about the importance of agriculture. I think it's not going to be a big surprise to anyone, but still good to highlight. So here I just put a slide of the importance of agriculture in terms of labor force around the world. So as we can see in emerging markets, especially, you have a big proportion of the population that works in this field. And if we take the example of Sub-Saharan Africa, it represents 32% of GDP and 65% of the labor force. And yet it is a field that is very much underfunded because you have only 10%, less than 10% actually, of commercial lending going into this, this sector. So we also know that this is a sector that is very important if you aim to alleviate poverty, because some studies showed that you're investing in growth in this agricultural sector is actually 2 to 4 times more effective in reducing poverty than it is to invest in other sectors. So that's kind of an interesting opportunity that we see here in that respect. And on the other hand, also the environmental concerns that we are all aware of. We need to transition into a more sustainable agricultural practices in terms of not deforesting new land in order to produce more crops, but we have to be more efficient, etc., etc. So yeah, I think we can all agree that this is a field that needs to be invested more heavily into. And so how does this translate into financing needs on the ground? So here I just put up the typical agricultural value chain, which starts with the input suppliers who sells the seeds and fertilizers, and also many times pesticides and those types of products to smallholder farmers, who then go through the whole growing season and sell to the aggregator, which can be either a cooperative or a local trader or other types of intermediaries. And then those aggregators sell to processing companies when they don't themselves already have a processing plant, who then sell to a distributor or an exporter, and then finally to a retailer. So those different stakeholders have different financing needs in terms of length of the loans that they need. So for example, a producer, depending on the crop that they are producing, they need anything from 3 to 9 months of working capital. And they have also very small ticket needs. Then you have the aggregators who have needs. They have huge financing needs at harvest time when they need to purchase from all the small farmers and then sell over time, over a few months, to processors or distributors. And on this later end of the value chain, you have those distributors and processors who typically have to provide some type of credit to their clients and also have some operations that require some more financing needs. And so that is kind of the whole structure of the value chain. And those are, again, working capital needs. And we're not yet speaking about long-term asset financing needs. And so, yeah, so of course, the ticket size, if you start on the smallholder farmer, you have very small ticket needs. And then if you go up, you need much more larger tickets. And also in terms of formality, it's not the same of running a due diligence on a small cooperative than it is to do it for a larger distributor. So I think I've given a few hints on what type of strategies can be implemented by investors in order to finance those different stakeholders and the characteristics. So in order to finance the smallholder farmers, typically it's done through microfinance. So you finance a microfinance institution who then lends it over to the end borrower. Then for the smallholder, so the small SMEs and cooperatives, this is typically done through private debt strategies, which are typically relatively liquid. So you invest for 3 to 5 years into those companies because you don't, there's not yet any strategy that can sustain the liquidity needs. I mean, much more liquid needs for those sectors. And then you have the larger SME segment that can be financed either through some semi-liquid strategies or more illiquid strategies. And those are characterized mostly by stable returns because you're talking about much more robust companies. And the impact there is also mostly through the standards that those enterprises set on the products that they sell and that they can produce. So either through sustainable farming or the way they, how fair is the trading that they do with the small farmers, those types of aspects.
And thank you, Itamar. Maybe could you precise, in terms of the financing horizon of these lending here, what is the long-term versus short-term financing that you see?
So here I spoke mostly about the working capital needs, and you have gaps in both working capital and long-term asset financing. I would say, of course, if you go into working capital, you can get much more liquid strategies. I mean, you can put in place much more liquid strategies rather than long-term assets. If you're financing a new processing plant, it cannot be done on a 3 months liquidity basis. So you need a longer term horizon. And yeah, so I would say the way to look at it can be that working capital strategies is more to help companies go by, operate in a more sustainable way, don't have cash flow issues, those type of things. Whereas if you invest in the long term, you're helping shape new industries. You can help transition into more sustainable farming, for example, create new factories, processing plants, those type of things.
Excellent. And so moving now to INOKS, so precisely we have INOKS operating in the SME sectors. So Nabil, could you tell us a bit more where you operate, geography, and also the types of loans you do, and maybe explain a bit the business model around the activities? How does it fit that small business sector?
Thanks a lot, Frederic, for this opportunity, for inviting us to participate to this webinar. Thanks a lot, Itamar. I will try not to paraphrase you because you kindly set the scene very, very well and very detailed and focused at the same time for the audience. So what is it that we precisely do, and where do we operate in the agri-SME sector? First of all, as a manager as an investment manager of collective investment scheme, the investment thesis of the funds we manage has to first of all fulfill a need that the market has, which is the liquidity, and you mentioned, Itamar, these needs are both of a short-term nature, medium-term nature, and long-term nature, depending on what the capital is required for. And therefore, even at the level of an SME might start with the sole requirement of working capital, and when it grows, maybe needs more investment into capex as it wants to integrate the value chain and beef up also its asset base to grow. So our job at INOKS Capital is primarily for the SMEs to provide them capital for growth, provided they are active in a non-speculative manner, and we will discuss this a little bit further, and are adding value in the value chain, and obviously are compliant with our ESG requirement and are offering not only potential but known impacts in very specific SDGs. At the time, we used to call them the do good points before SDGs were created, so to speak, and that's how come we operate in the SME sector. So from the field to the plate, if I would say so, except the pure trading parts. So anything that needs market arbitrage, we're not active in. We're adding in people. We're active with counterparties and SMEs, which are adding value by producing, transforming, distributing, aggregating, and moving along the commodity up into the value chain to the consumer.
And then you're naming quite a few pictures of the value chain that Itamar just showed before. Yeah. And I think that's quite interesting, Nabil. If you could potentially also give a few examples of visualize for the audience, give us a few concrete examples of what you finance from which part to which part of the value chain, and so we can really have an idea of where do we do where we can see the impact.
Well, absolutely, and I think we will give two examples briefly, but just as a theory in practice, you have to start from the beginning. So you have to start by if you are putting capital into production of inputs for distribution to small scale farmer, you need to make sure that the inputs qualitatively are the best, which offer the less residue possible in the land and in the soil, and if feasible, even transition to organic or extremely sustainable farming practices. So that's from the start. But giving some example, we can talk about what we like to do a lot, which is local food production for local consumption. And in that field, for instance, you can be active in rice or certain grain types, which need to be grown by cooperative or small-scale farmer. So you need to make sure that if you're funding the inputs from the seeds to the crop protection and the fertilizer, they are the best qualitatively, and in terms of farming practices, they are the most adequate, and that they offer no residues. And you have to help them also in that sense to give them an access to the market. So if you talk about locally produced food and locally consumed food, you're talking about import substitution, and this takes time. I mean, it's easy to finance a crop, but if the crop doesn't have access to market, that it doesn't serve any purpose. So at the same time, you should support these SMEs in getting an access to market, in having more efficient value chains and shorter value chains. And that capital, even working capital, can help, because if they are well funded, then they don't need to sell their produce to the distributors or to the processors in one go. They can sell as they go along post harvest. They could also invest in the distribution themselves to reach closer to the consumer. So they can create brand, you can create traceability and so forth. So that's one example. And rice is a very good example in sub-Saharan Africa, and grains are also a very good example of cooperative farming or small-scale farmers opportunities in Southeast Asia and in Central Asia. Latin America, it's a bit more complex. Now, if one discusses the other capacities or example, you can be funding the acquisition, let us say, of oil seeds to be crushed, and onward the seed oil, which is an added value product, and the respective byproduct, which can be used for animal feed, can be exported to consumer markets for the surplus, which are not local. And this is a very interesting, for instance, implementation of how you can be a proponent of helping this SME move up the value chain, also to add value by processing and exporting semi-finished or processed food-related products, so to speak.
So this is very interesting, because then you are expanding a little bit your lending in terms of the duration through the value chain. You're adding a few steps in the value chain. Now, when you look at it this way, compared to a traditional lender who would just finance the crop and have the guarantee of the crop, how does it change the way you look at the risk management? Because you are no longer having just a fixed lending to a particular aspect of the value chain, but it's moving.
Absolutely, and it's also a fact of benefiting from risk perception arbitrage, because technically, if at the crop level, for instance, you've been able to get rid of the price risk, then that risk mitigant overlay permeates to the byproduct and to the finished product, because it's a matter that you would have taken care of. So basically, your risk perception has to be a step-by-step or a sequence along the value chain risk identification process, whereby you identify all potential risks at the various segments of the value chain, and you seek to mitigate them dynamically. That is, you seek to address them as soon as possible in the value chain, so that they're not carried along in the value chain. So actually, you're not piling up risk. In fact, you're diminishing risk.
And if I may ask you to give an example, maybe to know, so we can picture that a little bit more.
Yes, absolutely. So let us take the example of a buyer of sunflower seed oil. To make sunflower seed oil, you need oil seeds. So you need sunflower seeds. Now, if you have a given price of that buyer, a fixed price for the sunflower seed oil, you can make by a reduction the price at which the SME should purchase the sun seeds. You can have the P&L on the cost of goods sold, and you can establish that there will be an incompressible P&L because your price is fixed. So actually, even though you've not fixed the price of the sun seed, using a price fixation on the oil itself, you have allowed the price of the sun seed as being the raw material component to be fixed. So from that on, then a farmer knows at what price he can sell his sun seeds. Okay, so you can then get them to talk to the processor. So that's what I was mentioning. That's an example of risk regression, whereby by fixing a risk at the end of the value chain, you're also countering the value risk at the beginning of the value chain. And the same goes from the farm to the export market.
And that requires a lot of, I guess, time, discussion. Maybe you could tell us a little bit in which country do you operate, or how do you go about your selections to be able to do such, let's say, more complex trades?
So obviously, this needs to be research-driven because it cannot be much opportunistic, because you need to have a high level of understanding of the value chain and the segments and the country. So we operate a top-down approach, whereby we select, first of all, the value chains and the commodities in the countries on the basis of what we call a strategic pipeline, which is defined first by the ESG inherent potential risk involved with the activity, the commodity, and the country, and the segment in the value chain. And then we also have inherent potential impacts that are known for that specific activity, country, and commodity on the basis of the SDGs that we have elected as our goals. And once we have identified that and we have validated the economic sustainability of the activity and the competitiveness and the comparative competitiveness of the activity, the country, and the commodity, I mean, complex, then we go at the micro level to seek to identify the best SMEs or mid-market companies which are providing us that activity. And obviously, once you have defined that, we have now been systematically active with this approach in Sub-Saharan Africa since 2006. We've been doing that also in Central Asia and ex-AS country, Russia excluded, and also more opportunistically, Southeast Asia and Latin America, not because the value chain are not able to deliver on the impact and ESG compliance, but more because the Southeast Asian and Latin American market are having substantial volatilities in the access to capital. At a certain point in time, they have excessive capital, and at other points in time, they have no capital at all. Mm-hmm. So that is very disruptive for the SMEs because they cannot plan their growth. And when capital is extremely abundant, it's good for the SMEs, but most of the time it's not well used, and it goes to consumer credit rather than production credit.
And Nabil, if we may digging into the risk, I see a question here that came around. You explain how you can reduce the risk in fixing the price. That's quite understandable. But however, isn't there still a compound of the risk, because you still take the different risk? You have the crop production, and then you have the SME operation. So how do you look at that?
We look at it in terms exactly as I mentioned of risk mapping. So when you operate a risk mapping, there are certain risks that are exactly the same at all segments. So if you mitigate it once, you mitigated it at all the segments. And obviously there are risks that are endemic and specific to that segment. And these risks you have to address on a per segment basis. But again, anyway, it's part of the process. Sustainability involves traceability. And I will use an energy terminology, but to agriculture, I mean, if you want to identify risk, it's not only to sit at your segment, you need to know the risk that comes before, and the risk that comes after. So downstream and upstream, you need to be aware. And in fact, the corporates, because we call these SMEs corporates, they're not micro SMEs, so it's not mom and pop shop. These are real corporates, may not have a lot of people or not a substantial balance sheet, but they are real corporates. If they embed that philosophy of understanding the value chain, understanding your impact, understanding your footprint, and the ESG compliance, these are corporates that tend to better understand the risk because they know better what's before them and what's after them. So they are the best to identify risks that are endemic to themselves and risks that are systemic to the value chain, so to others. And they are able, therefore, to also identify better opportunities.
That's pretty clear. Now, moving to the topic also of today, you know, how do you monitor the impact? And that's maybe also a question that I would like Itamar to opine on. You know, don't we have a trade-off between impact and return?
Okay, I'll take that one first, and then Itamar will come about. I think it's an antagonism that is mostly an issue against of risk of perception arbitrage. Actually, I was starting to answer the question at the end of my previous answer or comment, whereby first and foremost for us, ESG and impact, specifically impact, or a quest for efficiencies, okay? Because you want to generate efficiencies. Actually, in most of the SDGs, you can only deliver impact if you're efficient. Not by beauty of nature, but because you work for it, so to speak, and you're doing things differently than others, or in a more responsible and educated manner. In that sense, these companies are very efficient, and the fact that they are compliant to ESG and are able to generate impact is actually a dedication and demonstration of efficiency. And these companies are highly performing. So they make money and they are able to pay capital. So it's not antagonist as a relationship. Now, it is clear that when we started in 2006, such things as ESG, impact, were barely known to the investment community. At the time, we had our own, I would say, holistic approach where we say, do no harm, do good. The do no harm became the ESG, the do good became impact. But all this normalization process is also an educational process. And to cut the story short, I think it is in this educational process that people have tended to understand that impact equals an excessive administrative organizational burden, which is not. And that's from where people have devised that generating impact is antagonist to generating economic performance. Well, it is not.
Itamar, what would you think, being exposed to the very smaller actors in the field?
I would say when you speak about trade-off, there's kind of you kind of imply kind of a ranking in terms of impact. So I think here, if we take the theoretical approach that says that if you go into maybe smaller SMEs, such as the ones that I was speaking about, like those cooperatives or aggregators, here I think we can speak a bit about kind of a trade-off between impact and returns, because it's quite difficult to scale lending to this segment because it's so costly, for example, to serve it. So if you're doing $100,000 to $300,000 loans, it's very time consuming. You need a lot of time to do the due diligence because the companies are not well organized. And so it's in that respect, you can say that you have this trade-off because it would be more efficient, financially speaking, to just go with the big guys who can directly pay you and have much less volatility in terms of default risks, I would say. Not to say that it's impossible, but at this stage, it's not mature yet, I would say.
And I think if you allow me, I'd make the analogy with the microfinance, where you know, financing a micro credit or a SME is being very much discussed as well, into which one is making the most impact at the end. But I think I can leave the audience to draw their conclusion on this one, as it is a very hot topic in our investment space. Okay, I'm just looking at the time and see that we are coming to an end. I think maybe Nabil, if you could say just a last word on how do you see the regulation coming and affecting the market today? I mean, we have obviously ESG, you mentioned a little bit, but you have even new regulation coming up in Europe, as you can see. You know, how does it affect the agri-finance sector in emerging market?
It does at the same time extremely positively and extremely negatively. It's a bit of an awkward situation. So for ourselves, I mean, we have always been pro-regulation. You know, since 2015, we are a regulated asset manager of collective investment scheme by FINMA. We have always sought to be ahead of the regulation also, or the normalization in the field of ESG impact, being early adopters of IFC performance standards, UNPRI, and OPIM. That leads us where? That when the SFDR came about in Q1 2021 and the EU taxonomy, that allowed us to be immediately Article 9 dark green compliant, so to speak, which is great. But even with all of that, because of the regulation, you have certain service providers which are refusing to service your investments. Why? Because you're investing in agriculture, which inherently under the IFC performance standard is classified medium-high risk, so to speak. Typically, you're dealing with commodities, which are food related, which all or most of the service providers, such as custodians and trade banks, are very spooked about. And unless you're called Cargill, ADM, or Bunge, they basically are not talking to you and are not willing to, not even, and we're not talking about borrowing money because it's the fund's capital and there is no leverage, but just to service, because they understand there is an additional complexity that has to do with the AML, with the KYC, and with the also eventual reputational damage that they can have being involved in emerging market in difficult environment with small scale farmers or with small aggregators, SMEs, and they feel uncomfortable about that. So at the same time, you talk about Europe and others, they are promoting these type of investments, but the service providers are not following up and are not willing to service.
Challenges ahead is what is the conclusion, I guess. But the solution to private loan is not to be removed soon. That's how I understand it. I think I'm looking at the time and thinks that will be it for today. So thank you very much, Nabil, Itamar, for joining me on today. And as usual, we'll make a small summary of this webinar and a small 2 pages that we will share with you. And we'll also share the recording if you want to hear us again. Thank you very much and have a great day. Bye-bye.
Thank you. Bye-bye.